If you ask a really savvy real estate investor what's building their fortune, the answer might actually surprise you. It's often not the monthly rent check. Nope, it's something called depreciation, a kind of hidden force in a tax code that can be an absolutely massive wealth-building machine. So let's dive into how this all works.
So you'd think collecting rent is the whole point, right? I mean, for a lot of people it is. It pays the mortgage, it pays the bills. But for the most sophisticated investors, that rent check is just one piece of a much, much bigger puzzle. The real prize is something you can't even touch. It's something that happens entirely on paper. And that right there gets us to the heart of what we're talking about today. It's this tale of two different kinds of profits. You've got cash flow, that's the actual money hitting your bank account, and then you have these paper losses. I know it sounds a little backwards, but getting your head around this concept is really what separates the good investors from the truly wealthy ones. All right, so here's what we're going to cover. First, we'll pinpoint the real moneymaker here. Then we'll explain this idea of a phantom expense. After that, we'll look at how to supercharge your deductions and then how to use all of that to shelter your primary income. We absolutely have to cover the legal shield you need, and we'll finish up with the multi-generational endgame. Okay, first up, you see, the tax code isn't just about the government taking its cut. It's actually a system of incentives. It's designed to encourage us to do certain things, like, provide housing for people. And hidden right inside that system is this incredibly powerful tool that smart investors use to build fortunes. And here's the kicker. For so many of these investors, the real engine of their wealth isn't the rent they collect. It's this thing called depreciation. Look, rent can make you money, for sure, but using depreciation strategically, that's what can make you rich. All right, section 2. And this is where it starts to feel a little like a magic trick. How on earth can a property be worth more in the real world, appreciating every single year, while on your tax return, it's actually losing value? This is the paradox at the very center of depreciation. So what is it exactly? Well, officially, depreciation is an annual deduction the IRS lets you take to account for the wear and tear on a building. I mean, think about it. Roofs get old, carpets wear out, things break. The tax code basically says, hey, we'll let you deduct a piece of the building's cost each year to make up for that. And that's why you'll hear people call it a phantom expense. It's a deduction you get on paper, but it's not a real cash expense. You don't write a check to anyone for depreciation, but it lowers your taxable income just as much as a real expense does. It's this amazing deduction that doesn't cost you a single penny out of your pocket. Let's make this concrete with a quick example. Say you buy a house for $500,000. Now the land itself doesn't depreciate, so let's just say the building is worth $400,000 of that. For a residential property, the IRS says you can write that off over 27 and a half years. You do the math, and that works out to a tax deduction of over $14,500 every single year, even if your property value is skyrocketing. Now for section 3. That standard deduction is pretty sweet, right? But what if I told you there's a way to supercharge it? What if you could take years and years of those future deductions and pull them all forward into the very first year you own the property? Well, you can. And that's where a strategy called cost segregation comes in.
The whole thing hinges on something called a cost segregation study. See, instead of treating the house as one big thing that depreciates slowly, engineers come in and they break it down into all its little pieces. Stuff like the flooring, the HVAC system, the light fixtures, all of that can be put on much faster depreciation schedules, like 5 or 15 years. And with current tax rules around bonus depreciation, you can often write off the entire cost of those things in year 1.
And the difference is just staggering. Standard depreciation is like a slow drip of tax savings over decades. Using cost segregation is like turning on a fire hose of tax benefits right at the beginning. This frees up a huge amount of cash right away. And what can you do with that cash? You can reinvest it, maybe go buy another property, and grow your portfolio way faster. Okay, section 4. And honestly, this is the part that blows most people's minds. Because the goal isn't just to make your rental income tax-free. No, the real power move here is to generate such a large paper loss from your real estate that you can use it to legally slash the taxes you owe on your main income, from your W-2 job or your primary business. Now, the IRS has very specific rules about this, of course. There are two main paths that stand out. The first is the short-term rental strategy, think Airbnbs, where the average guest stays for 7 days or less and you're actively involved in managing it. The second path is to achieve what's called real estate professional status. This one has much tougher time requirements. We're talking at least 750 hours a year, and it has to be your main gig. But here's the key. If you're married, only one of you needs to qualify for the whole household to get the benefit. The impact here is just stunning when you see the actual numbers. Let's take two investors, A and B. They have identical properties, identical cash flow, $8,000 a year. Investor A just focuses on the rent, and they end up paying almost $3,000 in taxes. But Investor B uses this tax strategy. They create a huge paper loss, so they pay zero tax on their rent, and that paper loss saves them almost $8,000 on their other income taxes. Look at the bottom line. Their total benefit is over $15,000. That is triple the benefit of Investor A from the exact same property.
Section 5. Now, before you get all excited and run out to try this, we have to talk about protection. Because using these powerful strategies without the right legal structure is like building a skyscraper on a foundation of sand. It's just a terrible idea. Before you do anything else, you need a legal fortress. And for most people, that's a limited liability company, an LLC.
So what does an LLC actually do for you? Well, first and most importantly, it creates a liability shield. So if a tenant slips and sues, they're suing the LLC, not you. Your personal stuff, your house, your savings is protected. It also forces you to keep your finances separate, which is crucial. It lets you build up business credit. And this is a big one a lot of people miss. If you set up the LLC before you buy the property, you can avoid triggering something called a due on sale clause in your mortgage, where the bank could demand you pay everything back at once. And for our final section, let's see how this all builds into a plan that can last for generations. This isn't just about saving money on taxes this year. This is about a long-term framework for building and transferring wealth. You'll often hear it called the buy, borrow, die strategy. I know, it sounds a little grim, but it's actually genius. Here's how it works. First, you buy assets that go up in value, like real estate, and you use all these strategies we've talked about to minimize taxes along the way. Step 2, instead of ever selling that asset and triggering a huge tax bill, you borrow against its increased value. A loan is an income, so it comes to you tax-free. And finally, step 3. You die. When you pass that asset to your kids, they inherit it at what's called a stepped-up basis. It's like the IRS hits a giant reset button. The value for tax purposes is reset to whatever the market value is on that day, and a whole lifetime of capital gains and depreciation taxes can just disappear. And there are other amazing tools that fit right into this long-term playbook. Something called a 1031 exchange lets an investor sell a property, and as long as they roll all the money into a new similar property, they can defer all the taxes. You can do this over and over and over again. Some people call it swap until you drop, basically kicking that tax can down the road indefinitely. So after all of this, it kind of brings us to one final big question. Is the tax code just a burden? Is it just a set of rules designed to take your money, or is it actually a blueprint, a set of incentives that, if you understand them, can be used as one of the most powerful wealth-building tools out there? The answer? Well, it really all comes down to your strategy.